Well, hello. I hope you had a great Thanksgiving. And so we're back to work now. What I'm going to do here is last time I went through the notes for finite difference methods, which are interesting, but I think what we're going to do next is skip over, in the interest of time, to section 11, which is our first look at interest rate derivatives. Now, this is kind of an interesting area because, interest rate derivatives are a huge part of the derivatives markets because, as you can imagine, many market participants are interested in hedging interest rate risk because, let's face it, everybody's really exposed to interest rate risk. And what's interesting here is that a lot of what we're about to do is based on the Black-Scholes model. And so because of that, we don't need lattice methods to implement these models. We can do them directly in the same way that we were able to solve for the prices of European options directly from the Black-Scholes model. But the derivatives themselves are fairly complicated, so we're going to need some time to really understand them. So I think that it's a good idea, given how late it is in the semester, to skip over the code from the finite difference methods and just go directly into this discussion, because here I think I'll be able to find you several assignments that'll be very straightforward and very interesting and very useful. So I'm going to skip directly to 11 now and introduce interest rate derivatives and what's called the Black's model. Okay, now just a little history there. Black and Scholes, of course, produced the Black-Scholes model in 1973. Just give you a quick history lesson here. I guess we should say published because it originally took the form of an academic paper. And even that has its own interesting story. They have their own articles somewhere in the literature where they discuss what they went through to get this model published. It turns out that it wasn't well received when they first published this paper. In fact, they were rejected by 8 different journals before they found one that would actually publish this paper. And it turned out to be the Journal of Political Economy, which is kind of surprising that they would take something like this. But a lot of the very prestigious economics journals thumbed their noses at the Black-Scholes model, and I'm sure they still regret it to this day. Oh, well, that's what happens sometimes. It wasn't immediately apparent to anyone, including Black and Scholes themselves, that this was going to be a path-breaking development. They thought it would be interesting, but they had no idea how important this would prove to be. And actually, there used to be a science show on Channel 13 called Nova, which you may have seen or heard of. And somewhere along the way, they actually had a 1 hour episode about the Black-Scholes model. So you may be able to find it on YouTube. In fact, I'll tell you what, let's stop for a second here and look for it. It's quite interesting. It's not overly technical. Anyone can watch this documentary who's interested in the subject matter. Um, let's see if we have it here. There it is. I think that's the one. The $1 trillion equation.
Let's see. I'm sorry.
I'm just going to make sure. Hmm. All right. I don't think that's the one I had in mind, but it looks pretty interesting. So I'll tell you what I'm going to do. I'm going to save this link. Um, First, I'll give it a thumbs up, which means I'll always have a copy of it. And I'll put this link in these notes so you can watch it if you want to. I think you'll find it to be incredibly interesting. Um, I think there's more than one out there, but I can tell already that one was going to be good. So I'll put this in here so you can watch it at your leisure. But and again, the reason why this is so important for this section is because what we're about to do is derived from the Black-Scholes model. Now, what happened here is that in 1974, Hubbard published a series of papers in which he showed, oops, how the Black-Scholes technology could be used to price European calls and puts on any asset in the market, not just those without any cash flows. Okay, remember the original Black-Scholes model only works with non-dividend paying stocks. Okay, and even then, it only works for call options. We need put call parity to price puts, so it was very restricted, very limited. And they, again, that's maybe one of the reasons why they had no idea how important this would prove to be. And plus, at that time, there was very little activity in the options markets. They existed, but it was a very small, obscure market that had almost no activity at all. Well, if they could have seen what was coming, after this paper was published, of course, the volume of trading in derivatives exploded. Many new types were introduced in the next several years. And of course, it became the gigantic market that we know now. But Merton helped push that envelope because he was the one who said, listen, we can use this for other types of options besides European call options on non-dividend paying stocks. Now, in 1977, I believe, 76, sorry, 1976, Fisher Black published a paper in which he showed how the Black-Scholes model could be extended to futures options. Of course, a futures option is an option where the underlying security is actually a futures contract written on some other asset. For example, you could have an option to enter into a futures contract to buy British pounds or to sell British pounds. And you might think, well, why do we need that extra layer of complexity? Well, it gives the investor the ability to enter into a position without ever needing to actually buy or sell the underlying security. So like if I buy an option directly on British pounds, I may find myself needing to buy them in order to earn profits from my option. Or if I have a put, I might have to actually sell them. With a futures contract, that isn't necessary. It's possible, but it's not necessary. So it makes it easier to hedge a position without necessarily wanting to buy or sell the underlying security or asset. So because of that, futures options became very, very popular very, very quickly. And in fact, at this point in time, the majority of options that are trading in the marketplace are actually futures options. So that's why this suddenly became so important. Fisher Black realized that, you know what, our model is great, but it doesn't work with futures options. So I'm going to have to figure out how to change that. So he publishes this paper in 1976 and shows the world, yes, here's how it's done. Interestingly enough, the methodology used in this paper was extended to pricing European interest rate options. Now, there are many different kinds of interest rate options. We'll have to go through them very carefully. It's a little bit messier than, let's say, stock options because of the properties of interest rates, and also because of the fact that in many of these cases, there really is no underlying security at all. In other words, if I buy an option on, let's say, the federal funds rate, there's nothing to be delivered. If I exercise that option, I can't be delivered in interest rates. So instead, these are typically cash settled. And that works just fine for most hedgers because they don't really necessarily want to get involved with buying or selling or exchanging cash for some underlying asset. Instead, they're simply looking for a pure hedge on their position. So it's this paper that was adapted to the pricing of interest rate options. Now, there's some fudging going on here. The assumptions of Black-Scholes are not necessarily perfectly suited to interest rate options, but they seem to do a pretty good job. And they're still used to this day on Wall Street to price interest rate options. So this is awfully important, and we're happy to have it because you certainly can use lattice methods for American style interest rate options, but it turns out that most interest rate options are actually European style because they enable hedgers to hedge an exposure at a specific point in time, which means it doesn't do them any good to be able to exercise them early. So in other words, American options in this area are not quite as important because hedgers often are interested in hedging interest rate exposure at a specific point in time, which means there's no point in paying for a more expensive American option. All right, so anyway, this is where we're going. So we need to do two things. We need to see how the Black-Scholes model is adapted for this purpose, and also to introduce these interest rate options that we'll be pricing. And they're very, very powerful and very flexible. You'll be surprised how many of them are out there and what they can do. But they're fairly complicated. It's going to take a while to figure out what exactly we're trying to do and how they're priced. So anyway, with all that being said, wait a minute, what happened here? I don't think the right file is open. Hold on a second. Oh, this is it. Okay. I just wasn't sure. All right, let me just make sure I've got everything open that I need. Yeah, this is the document that we'll be looking at. You can see there's a lot of details here. This is a bond option. We also have several others here. We have something called a caplet, floorlet, pair swaption, receiver swaption. It's a very complicated market. So we're going to look at some of the most important ones, and we'll see how they're related to the Black-Scholes model. All right, let's get back to it. There we go. Now, most of these are traded on, well, I mean, they're all either traded on organized exchanges or the over-the-counter market, but because they often need to be customized to the needs of the individual hedger, we find most of these trade in the over-the-counter market. You might find some interest rate derivatives on the CME, for example. There's probably some, but they would tend to be based on an underlying security like a treasury bond, let's say, as opposed to an interest rate. But you never know what they might have. These guys have everything under the sun. So why don't we just take a quick look and see what they have available today. And of course, as I may have mentioned before, the Chicago Mercantile Exchange is the largest derivatives exchange in the United States. Let's see, date markets, that's what we want. So under interest rates, they have treasuries. I mean, when they say treasuries, they mean derivatives written on treasuries. Like here, these are all futures contracts, which are very, very popular for hedging purposes. Because again, you're not ever required to actually take delivery of these treasury securities because you can unwind your position as you need to. Now, here there's some on. See, now SOFR. Now this has its own interesting story. There used to be, and there still is, I guess, an interest rate called LIBOR, which stood for London Interbank Offer Rate. Let me just quickly add this here. Refers to the rates that the largest London banks charge each other for short-term, often overnight loans. Now, why do they need to do this? Well, here's the thing. In the United States, at least, the Federal Reserve System requires the banks to hold a certain amount of their deposits in what are called reserve accounts at the Federal Reserve. And the purpose of that is to make sure the banks don't go nuts and lend out every nickel that they bring in so that they don't run out of money when customers need it. We don't want any bank panics, shall we say. So there's a certain percentage, which is fairly small, of the deposits that the banks may not lend out. They must be kept in these reserve deposits at the Fed. And the same thing is true in the UK, of course. So what happens sometimes is that a bank may find itself a little shy of its reserve targets, and it needs to avoid getting into trouble with the Fed. So what it might do is borrow surplus funds from another bank just to cover the shortfall, typically just for a very short period of time. It would be almost like, imagine if your mortgage is due on the first of the month, but you're not getting paid to the third, and you go out and borrow money for 2 days to cover that mortgage payment. It would be a comparable idea. So this is a fairly active market. The banks are constantly lending and borrowing money among themselves. Some banks just want to earn a little extra interest, and some of them don't want to run into trouble by not having enough funds with the central bank. So the rate that they charge each other is called LIBOR. And there's a LIBOR rate for all of the major currencies. Now, having said that, this used to be the most important, really maybe the most important interest rate in international markets. It was many contracts were based on LIBOR. Well, what happened? Sadly enough, I don't remember the exact year. Maybe we can find out. Was it maybe 10, 15 years ago? Oh, well, what happened was some of these investment banks, if I remember correctly, Barclays was one of the big ones. The traders were manipulating the rate to take advantage of it and either put money in their own pockets or put money in their clients' pockets. And so when the fraud was discovered, the British Bankers Association, which is the one that sponsors this rate, they're the ones who actually calculate it at the end of each day. Um, they decided that, there's nothing that could be done about it. They could send people to jail, of course, but the rate itself was too easy to manipulate, and that they needed to come up with something else so that this wouldn't happen again. And so every single country now had to come up with an equivalent rate of interest, which referred to a very low risk short-term loan. And in the United States, the Fed created a rate called SOFR to take the place of LIBOR, dollar LIBOR, that is. It stands for Secured Overnight Financing Rate. And you can see these are the numbers that we're looking at right now. But the actual meaning of it, yeah, there's still some LIBOR quotes, but not nearly what it used to be. Here it is. The Federal Reserve has an explanation here. No, they see, they've only had it since 2019, 2020, when the scandal erupted and they needed to find something else. Basically, let me see if I can find the exact definition. It's a broad measure of the cost of borrowing cash overnight collateralized by treasuries. Okay, so in other words, this is what that means. SOFR, I forgot. Secured overnight financing rate. This is the rate at which cash can be borrowed for very short periods of time. Um, when collateralized by treasury securities. So as if I'm a bank and I need to borrow money in a hurry, in the past I might have gone into the LIBOR market, but now what I could do is this. Bank A sells a treasury bond to Bank B, or let's say $1 million, and promises to repurchase it, let's say the next day, for I don't know what would make sense. It says here 4%, but that's for an entire year. for one day, let's say you're promising to pay back $1,158. Okay, fine. Okay, so the implied interest rate, the $159 is the interest payment or the loan, approximately 4% on an basis. Now, if Bank A fails to repurchase the bond, it keeps the $1,000,000, but Bank B keeps the treasury bond. So there's essentially no risk in a transaction like this. So that's why the rate is so low. It's going to be the lowest rate you can find in the economy, basically. And so now at this point in time, often derivatives are based, the payments to interest rate derivatives are based on the SOFR rate, at least in the United States. In other countries, they have their own version of SOFR. And it's hard to keep track of them all. It used to be simple LIBOR. It was dollar LIBOR, pound LIBOR, yen LIBOR, you name it. It was so easy to keep track of. Now every one of them has its own unique name. And so I'm sure traders on Wall Street had to learn all these terms. But if I have an interest rate cap, let's say, chances are the payoff will be based on SOFR. Okay. In the past, it would have been LIBOR. Now it's going to be SOFR. So this is something I can see in the market every day. And that's what's going to determine the payoff, if any, to my interest rate option. So there you go. Oh, I forgot to mention, there was a scandal in, let's say, in the early 2010s, I'm going to say, in which it was determined that traders at some, not all of them, the major London banks were fraudulently, and I don't know exactly how they pulled it off, but were fraudulently manipulating the LIBOR rate to benefit themselves. As a result, newer rates were developed to be used as a substitute. I don't know if anyone actually went to jail, but I'm sure there were a lot of fines. People, I'm sure, got fired, et cetera, et cetera. It's hard for a bank to live it down when their traders are crooks, you know. It's reputational loss, the whole 9 yards. But so that's why this happened. I mean, the market had been around since the 50s. And yet, you know, a handful of crooks, that's all it takes to ruin anything. That's just the way it is. So anyway, so these are much different because for one thing, LIBOR is a kind of an average. It was never a true market rate of interest, whereas the SOFR rate is an actual market rate. This is what the banks are actually charging each other right now at this point in time. And this information is completely accessible to the Fed, and they can publish these numbers so we can all see them. There's nothing mysterious about it. There's nothing being hidden. So it's easy to use these as the rate for any derivative contract or others as well. Now, in the slides, you'll see that they're still referring to LIBOR. Okay, well, let's just pretend that we're still using LIBOR. It amounts to the same thing. All right, anyway, with all that being said, let's get back to this. Yeah, you can see at this point, it's around 4.5%, whatever. And then, you know, they've got the records of how many, look at the volumes, $2 trillion. Wow, it's even more than I thought. Of transactions were made on November 27th in this market. So that shows you how big it is. So again, remember, these are just small, I mean, short-term overnight loans for liquidity purposes. That's all it's for. And then again, every other country in the world has their own equivalents. In fact, maybe we can look them up. What are the foreign equivalents? SOFR. Oh, here we go. Uh-oh, what happened? There we go. So Sonia is used in the United Kingdom, Esther in the European Union, Japan is Tona, and Switzerland is Sarah. Can you imagine having to memorize all these names? Come on. It was so easier, much easier when it was pound or sterling LIBOR and euro LIBOR and yen LIBOR and Swiss franc LIBOR. It was so much easier in those days. One good thing about these, though, is that the numbers are actually published by central banks instead of private banks. So the chances of something being corrupted are much lower, of course. All right, anyway. So exchange traded derivatives, and they're expanding this all the time. We have euro dollar futures. That is a hugely important market. A euro dollar, it's a very interesting name. Euro dollars are dollar deposits held outside the United States. Typically London. London is the center of this market. Each major currency has an equivalent um, type of deposit. For example, you have euro yen, euro sterling, which is pounds, etc. These are collectively known as the euro currency market. Now, the thing is, before the currency, the euro came along, the prefix euro did and still does mean outside of the country of origin, like euro bonds, for example. If an American company issues bonds in the United Kingdom, they would be known as euro bonds because they're not British bonds, they're American bonds. So then the euro comes along, and so there's some potential for confusion here. But euro dollars sounds like, what do you mean? Is it euros or is it dollars? No, it means dollars held outside the United States. Now, you can imagine this is a popular market for multinationals who are constantly earning funds or paying bills in different currencies, and it might be helpful to have deposits of these different currencies in, let's say, London or Paris or Germany or Berlin or whatever. The rates that they get paid earn slightly more than domestic deposits, same maturity. Because these, by the way, have a time attached to them, like 90 days and that type of thing. Um, so usually you can do a little bit better in this market, interest wise, because they're not subject to US banking regulations. So that's a big deal. Keep your money in London, the US can't touch it. Well, of course, if you're a criminal, they could probably do something, but I mean, they can't tell you what to do with your own money if it's not even in the United States. So you can move it around between these different euro currency accounts as you need them. Like if you're earning yen from one of your divisions and you're paying euros in another division, it's very convenient. This is a massive, massive market. I don't know. Let's see if we can figure out how big it is. It says about $14 trillion. Yeah. Ooh, that's a big market as of April 2022. And yes, they're making a point here that it has nothing to do with Europe. The example they gave here is a Korean company keeps their funds in South Africa. That would be Euro won, I suppose. But so yes, now there is an actual futures contract. It's based not on the euro dollars themselves, but the rate that they're earning. Okay. So in fact, if you were to go look at Right. And again, I think I mentioned it that this is not like your savings account where you keep the money there and you can take it back whenever. These are time deposits, which means they have of maturity. I believe the ones that are underlying futures contracts are 90 days. So, typically with a time deposit like that, you'll get a slightly higher rate of interest in exchange for leaving it there a specific length of time. So since time deposits are not held inside U.S. borders, they're outside the jurisdiction of the Federal Reserve. There's a lower level of regulation, and therefore, now, having said that, though, that does introduce a small amount of risk, but it's like the idea that a foreign government might suddenly confiscate your deposits. It's so ridiculously absurd that nobody really worries about it. But or if like if you keep your money in a bank that fails in the United States, you're covered. Here, maybe not so much. So there's some potential risks here, but you're basically getting a higher return to compensate you for the avoidance of US banking regulations. So now, ironically enough, the Eurodollar market got started in the 50s because of the Cold War. What was happening is that, when Stalin was in power, he was a monster and he was constantly doing things that the United States didn't appreciate. And, Stalin basically stole all the people's money and he had it in his own personal bank accounts in the United States. And so got to the point where he was concerned that the US government might confiscate his deposits if he went too far, let's say, by invading Europe or something. So he decided it would be safer to keep his funds in, let's say, another country, England, for example, but yet still hold dollars. He didn't want to hold pounds. He wanted to hold dollars. So arrangements were made for him to keep his funds in a British bank. And then suddenly people realized, that's not such a terrible idea. Maybe we should think about keeping dollars in London. And the market was born. And so now the CME comes along and introduces a Eurodollar futures contract. Now, the purpose of this contract is to hedge the risk that the Eurodollar rate will rise or fall. Okay, that's the whole point of it. And the contract is based on 90 days or 3 months, and it is cash settled. And that means that when the 3 months are up, where your contract will be based on the interest rate at the time of the maturity of the contract, and that will determine if you get a payout payment or not. Now, it's possible in this case for you to gain money or lose money. It's not an option where you can't lose. Your payoff can't be zero. Sorry, your payoff can't be negative. But with a futures contract, you could gain or you could lose. The point of it is that if you are borrowing money in these markets, you want to hedge the risk that interest rates will go up. So you might find yourself entering into one of these contracts, which will provide you with a payment if rate borrowing costs do go up, for example. So, um, yeah, yeah, we can go back and revisit this again later on. Oh, here we go. The price of Eurodollar futures to reflect the anticipated LIBOR. LIBOR was discontinued altogether in 2023, so it still took a while to get rid of LIBOR. SOFR is being used now instead. And we'll see in later on in the slides how to actually calculate the payoffs to a Eurodollar contract. It's a little bit messy, but and also because of the way it's quoted, um, well, you'll see when we get to that point of how the prices are determined. But yeah, I think this is a very good article. So anyway, that was just one of the many examples of interest rate derivatives that we can find. So futures on Eurodollars. Now, whenever there's a futures contract, almost invariably, there's also an option available on that futures contract. So we went to the CME. I'm sure we could find if that's available or not. So here's SOFR. That's what got this conversation going. SOFR, 1 and 3 month futures. They don't go out any further than that. 30-day. Now, the federal funds rate is the rate, that's the monetary policy rate that the Fed sets. They decide what rate of interest we should have in the economy to keep it stable, to keep it growing, to reduce inflation, et cetera, et cetera. The Fed funds rate at the moment is about four. God, I've forgotten. They changed it twice in the last couple of months. Let's see. Here it is. No, all right. Well, that's nice, but I'd rather have a chart. Um, you can see it comes and goes. I mean, in the 80s, when inflation was early 80s, inflation was completely out of control. It was up over 19%. Down here during the COVID, it was essentially zero. But it's much more normal for it to be up around 3, 4, sometimes even 5%. Basically, this is the rate at which American banks um, borrow from each other, but it's not collateralized. In other words, if they just borrow money for deposits, these are usually transactions where banks are falling short of their reserve requirements and they need some money in a hurry to avoid getting into trouble with the Fed. Um, these would not be collateralized, so it's a bit of a different case than SOFR. And so I was hoping to get a chart here. Oh, here it is. Oh, man, I think somebody goofed. No, no, no. Something's not right. The New York Fed should have this. Well, these guys should have it. Just a quick chart, please. I'm telling you. Oh, no, 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 no. Oh, here we go. This might be it. Oh, no, I see what they're doing. They're breaking it up into recent history. All right, come on. Let's see. There we go. Now, if you notice, it's typically a range. The reason why it's listed as a range is because they know that the rate can fluctuate in the market. This is an actual market rate of interest. The banks determine this rate, not the Fed. The Fed sets a target for it. That's all they do. They don't choose it. I mean, they don't say this is the rate and that's it. They say this is our target. And what that means then is that, like, for example, right now, if it starts to drift below 4.5%, they'll step into the market. And what they'll do in that case is, in order to raise the rate a little bit, they'll withdraw some reserves from the banking system, and that will nudge the rate back up. If it's getting too high, above 475, they'll put more reserves back into the banking system that they can lend out, and that will push the rate back down again. So this is the rate that the range within which they're willing to accept. Anything outside that range, they'll take steps to push it back into that range. So they've got a target and they can nudge it in different directions, but they don't actually set the rate. That comes from supply and demand in the banking system. Okay, so if the banks don't want to borrow, the rate drops. They want to borrow like crazy, the rate goes up. The Fed eventually at some point will step in and adjust the rate by either buying or selling or changing the quantity of reserves in the banking system. Now, if you notice, it's at 4.5. That's historically a fairly high level. Back here, look at this in March 2022, when we were still coming out of the COVID, it was down as close to zero as it's going to get because of the COVID destroying the economy. Then after a while, inflation started to rise again. And so they started to go berserk, raising it very quickly by their standards. And within slightly over a year, it was up 5 full percentage points. You don't see that very often. That usually indicates there's a crisis of some kind happening. Normally, it goes up in small stages, very small stages. They're very patient usually. But they have the ability to do whatever needs to be done to keep the economy as strong as possible. They have a lot of power, maybe more than people realize. They're completely independent of the federal government by design. and they actually have their own budgets. They don't even have to go to Congress for budget. So they are pretty well insulated from political pressures, and they will need to do whatever they feel is necessary. Well, anyway, so that you can see there's a derivative based on the Fed funds rate. So these are the much more specialized ones. Treasury bills, these are the very short-term securities issued by the US government. These have maturities of a year or less. Um, yeah, there's all kinds of stuff. I'm not seeing any options though. I wonder if they have any options. It's possible that the options are coming from the over-the-counter market because they often need to be customized to the needs of the individual hedger. So it's very possible that the CME doesn't even have options on interest rates. Whereas futures, they're very standardized, they're very liquid. It's easy to use them for hedging purposes up to a point. If you need something more specific, then you really have to go to the options market and get what you want from, let's say, a counterparty like a Goldman Sachs, for example, could design one for you. Anyway, so we have treasury notes and bonds. Now, by the way, if you didn't know this, in the treasury market, the names are determined by the maturities. Treasury bills, the maturities. I think the shortest one they have is 1 month, 1 year. Treasury notes maturity ranges from 2 to 10 years, and treasury bonds maturity ranges from 20 to 30 years. That's all they have. It doesn't go past 30 because nobody wants them. I mean, these maturities are determined by market demand. This is what people want. And so the Treasury, by issuing these securities, they're doing this to borrow our money. They have deficits every year, as we know. And so the only way they can pay for them, they don't have enough tax revenue, is to borrow it. And this is how they do it. And so they have a lot of maturities to choose from because everybody in the market needs something different. For some investors, the treasury bills make the most sense. For others, treasury bonds, and we have everything in between. In fact, it's gotten to the point where you can get online and buy these. You can set up an account with the Treasury Department and buy these directly without any brokers getting involved. And the minimum investment is all the way down to $100 now. So they really want you to lend them your money. Didn't work, used to work like that. It used to be a very complicated process to buy these things. Now it's a breeze. Okay, but they need that money. All right, what else? Now, these are the options that we're going to be looking at. The name means nothing to you just yet. We'll get more deeply into this later on. Caps, floors, collars, and swaptions. Okay, these are the options that are written directly on a rate of interest, and the purpose of them is to hedge the risk that rates either go up or down. Although you can use them for speculation too. There's probably easier ways of doing that. These are often used by hedgers more than speculators. And like I said, they often are customized to the needs of the specific hedger. So caps, floors, and collars are kind of all lumped together here because, interestingly enough, these products are effectively portfolios of options. They're not really individual options. They can be thought of as portfolios of options. Because, for example, what if I'm worried about rates going up over the next year and every 3 months I need to make a payment of some kind? I might buy a cap, which consists of what are called caplets that mature every 3 months for the next year. Okay, so in other words, I've got coverage for every 3 months for the next year. On each date, I either exercise or not, depending on whether rates have gone up or not. And so these are structured typically that their payoffs occur every 3 or 6 months or maybe a year. And they're all European. Because like I said, it doesn't do us any good to be able to exercise them early because we're trying to cover exposure on a specific date. So these are almost always European style. And that's why they can be priced with the Black-Scholes model. Okay, you see how beautifully that worked out. In fact, Black himself never realized that this was going to happen. He, I guess he was like, he's watching these others take his model and do all these interesting things with it, and I'm sure he was pretty amazed by what was happening. But caps, in a nutshell, are designed to help us uh, hedge the risk of rising rates. Floors let us hedge the risk of falling rates, which means they are in effect a portfolio of puts. And a collar basically gives us coverage on the upside and the downside, meaning it hedges interest rates from going up too high or down too low. So they're basically a hybrid of caps and floors. Wow, what an interesting market this is. So now this is kind of involved. So I think maybe we better knock it off right about here. So next time what I'll do is we'll cover the properties of these things, and then we'll look at the Black-Scholes code. And then I can give you an assignment where you'll be asked to do, let's say, a floor or something based on the Black-Scholes methodology. So, all right, I guess we better stop here and let's see you next time.